welcome back to the Don and Gino Real Estate and Finance Show right here in your hometown station, AM 1220 KHTS.
And remember, our goal is always to guide you to personal and financial wellness.
Well, you're going to be glad you stuck around for the Don and Gino Real Estate and Finance Show for our final segment of this week's show. That's right. Every Saturday, 9 a.m. to 10 a.m., we get to share with you such great information, what you need to know, want to know, should know about real estate, finance, your community, and our public awareness announcement we just had in the final segment. So if you haven't heard about wire fraud or how you could potentially lose a lot of money or all your money during a real estate transaction, you better listen to our segment we just had, and you can find that at donandgino.com.
Yep, it's super important. You know, we went over it in detail for 10 minutes, so to protect yourself, check it out at donandgino.com. So now we're going to talk about a lot of good news, and some people might interpret this as bad news, and it's only bad news if you haven't done what you needed to do over the last few years.
Like buy a house?
Yeah, so if you haven't, and I know we've only been saying that for, what, 7 years now? That you should buy a house, that we've hit rock bottom. We started saying that in 2010.
Yeah, maybe 6 years now, six and a half years.
Yeah. So
when we first started the show, it was pretty much doom and gloom.
It was pretty bleak.
And we started the show strictly to give you some, some avenues and some hope and some direction and answer questions regarding how do I handle all the hardships we're dealing with at that time during the housing crash. And that's where we basically started the show. And then luckily things started to turn around.
So, you know, what's interesting is since then, with all the market stimulus, and you've got to give the government some credit for the tremendous amount of stimulus that they threw at this economy, hoping that it would work. And what we're seeing today is the result of all that stimulus working very well. And we also have the danger of all that stimulus creating some sort of bubble. Asset bubbles, and we have multiple asset bubbles that are potentially at play. You've got the stock market, which is struggling against market highs that it has. You've got the housing market touching up against new highs again. You've got a lot of things that are reaching new levels. Unemployment at lows.
Right, and a tighter labor market.
Student loans, all-time highs, right? Debt from student debt is at all-time highs. Debt from mortgage debt is at all-time highs, but debt from credit card debt is not at all-time highs. So that's something to keep our eye on.
Right. So what does this all mean? Okay, so I'm going to kind of let you know where we feel we're at with the economy and the housing market and all that, because you're going to hear a lot of opinions, which is put it that way, pluses and minuses. You're going to also hear a lot of people telling you that there's a bubble coming around the corner because we're at all those highs that Gino talked about. But then again, we get like all the reports we have today and future reports and estimates for the future, and it looks really strong. And the one thing you're going to hear about is interest rates going up.
Yep.
But why is that?
Well, that's the thing. Right? So because, like I said, there's some fear that all this additional stimulus has the potential to overstimulate this market. And then we're starting to see some inflation, Don. And I know that's what you're alluding to, but we're starting to see some inflation. And as the inflation creeps in, the way the Fed and everybody tries to curb inflation is by increasing interest rates. If you increase the cost to borrow, people will borrow less. And if people borrow less, the economy will slow down.
Correct.
In theory.
Right. Well, they're just trying to curb inflation, which is the cost that you're paying for products, basically.
Right.
They don't want it going up too fast. Their goal is 2%.
Yeah.
And they've held it right below 2% for a long time, and now it's cresting close to 2%. So the market's gotten nervous, and therefore the interest rates have gone up.
Right. So the reason that interest rates go up is because interest rates are a yield that someone receives on their investment. So if the dollar is losing its value because there's inflation, then I need more dollars to offset that, and I need a better yield. So I need a better return on my investment in order to offset inflation. So hopefully that makes sense.
Yeah.
And so what's happening is people are asking for a better return on their investment via the stock market, via bonds particularly, and those bonds are relating to higher interest rates on long-term mortgages right now.
That's right. So if less people are interested in, because the stock market's hot, and people are putting money into the stock market, therefore less money is going into bonds, fixed assets. So to attract more people to obtain our debt, our fixed assets, then they have to raise the interest rate to attract more buyers. So that's why rates have now gone up some. But the good news is Have they gone up a ton? We're talking when you're going to hear that rates are some of the highest levels. Just in the last couple weeks, they've gone up no more than 0.25%. It's
I know.
nothing dramatic.
Psychologically, though, it's traumatic, right,
Yeah.
Don? Because if something goes up from 4.5 to 4.75, like, oh, because we do have very expensive homes and affordability is cresting, is creating some challenges for some folks that maybe didn't get into the market when they could have, didn't take advantage of the lower rates when they were available. And now they're a little on the late side of the spectrum, but they still want to get in before it gets too late.
As you should, because right now in Southern California, we are the second most expensive. You have to make the second highest amount of money to be able to purchase a home in California, only second to Hawaii, believe it or not.
Wow.
Yeah, Hawaii, you need to make $111,000 a year to basically purchase, on average, purchase a home, and it's $93,000 here in California.
Unbelievable. So yeah, it's a very expensive place to live, especially because that factors in taxes and all the other
Right.
things of why it costs money to live here in California.
That's an average, by the way. That's just done by a report.
Sure, no, that's fine, but it gives you some concept. So, rates going up is a good thing because being from from Argentina, I can tell you that inflation is a worse thing. Inflation is a very dangerous thing, and when you experience hyperinflation like they do in Argentina or like they did in Germany.
They did here a little bit back in the 70s.
A little bit. And what did we have to do to curb it? The interest
Rates
rates went to 14%.
Freaking 18%, I think.
Yeah.
It was ridiculous.
So I think the new Fed is doing a good job. They started early when no one thought we should raise rates. They started raising rates. And I think that they show some foresight that they needed to start raising slowly so that when we came today, we don't have to raise them quickly to try to stop this because that destroys economies.
Correct.
So this slow bleed, as they said, I think 2 years ago, it'll be like watching paint dry. And they've been doing a quarter almost every quarter. And this year they'll probably do a quarter almost every quarter. And at least that's what we're anticipating for this year. That's on short-term rates. And the market will respond on long-term rates as well, depending on what other investments are doing.
And believe it or not, so what does this mean for the housing market? A lot of you go, oh, if rates are going up, it's going to kill the housing market. Well, the reason rates are going up is, like Gino said, that means the economy is doing well. That also means confidence, which is now at one of the highest levels since 2006, believe it or not. So you're confident that, one, you're going to keep your job, B, that you're going to be able to make your payments, C, you might have a raise down the road. So the confidence is good. That means the housing market is going to remain strong. That means you feel good about it. So because of that, appreciation levels are continuing on home prices. We're talking to the tune of now, we just got a new report. They were expecting 4.8% this year. We said, it's going to still be above, closer to 6%. This last report shows 6.8% across the board. They were thinking 6.2, but it's 6.8% across the nation. And we're talking close to 8% here in Los Angeles and over 12% in Seattle. So we're still seeing some great appreciation across the nation.
So those are hot numbers, right? That's a lot of appreciation from these levels that we're already at right now. It was easy to have double-digit appreciation 6 years ago where our prices were nothing. But to see 6 and 7 and 8 and 12% appreciation in this market is definitely interesting. But, I think you touched on a key point there is that the future is bright, confidence is high, and if I believe I'm going to get a raise next year, it's all good.
Well, in the market being tighter, there is a better chance of you finally. First, we had to fill the market with a lot of us that didn't have jobs, and now that the jobs are filled, now to retain you or obtain you, they're going to have to pay you more. So that's making you feel very confident. Now, is it keeping up with the pace of the home appreciation? Not in some areas in Southern California, Gino.
Now, what you have to remember, too, though, is if you travel outside the United States for a minute, right? Because I have a good friend of mine that left and went to Italy. And I was talking to her the other day, and she says, it is so expensive here. She says, the best job I can get is $10 an hour. And she goes, and I can't get anything. I can't live for that price. And I know in Argentina what people make versus what things cost. They can't live for that price. So they live very, very, very simply. And they don't have, maybe they share one car for the whole family and totally different lifestyle. But think to yourself, it could happen here. It could get very expensive to live should inflation continue and we don't raise rates. So remember,
that's good. Raising rates are good.
Raising rates is a good thing. So just remember it's not a negative thing that rates are going up. It's a positive thing. And as long as they go up moderately, we should be good.
And therefore, before they go up any more potentially, you should get into the housing market now because rates affect your purchasing power or your payment more than the sale price of a home. So please, if you're waiting to save up more down payment, you're going to go backwards in time. I'm telling you.
Yeah.
So reach out now. You can reach out to us anytime. SantaClaritaHomeLoan.com. www.SantaClaritaHomeLoan.com or donandgino@gmail.com. Reach out to us. You might be surprised how soon we can get you into a home before rates go up anymore.
That's right. We'll do a cost of waiting analysis for you to make sure that you know where you stand today and what it could potentially cost you if you wait. We want to make sure that you're able to take action should you choose to.
All right, you heard right here on the Don and Gino Real Estate and Finance Show. Thank you for joining us every Saturday, 9 a.m. to 10 a.m. You can always find out more at donandgino.com, and have a great weekend.